All right, so today we're going to pick up where we left off with the file on Monday and complete what's called an as-is valuation of Nike. So two things. One, you need to be logged into Bloomberg to complete the next step. So make sure that each of you are at a terminal ready to export data to complete the model that we're working on. And also make sure that your Excel file is loaded and ready to go. So just to kind of give you some context, where we are right now is we have forecasted 6 years worth of financial statements, which have created 6 years worth of economic statements and cash flows for Nike. Our next step is to turn those cash flows into a valuation that is also what's going to be called an as-is valuation, which means we're going to value Nike very close to their current share price. And the standard for an as-is valuation in this class, this semester, is within $1. Okay? So that's our next step. But in order to do that, we need to make sure we have the most current data for Nike. And Nike, believe it or not, has a very odd fiscal year. Most companies, fiscal years end December. Nike's ends in May. And the data that we actually have in our model right now goes through May 2018, but Nike has actually released their results for May 2019. So your next step is to take homework 6 and to take the model that you've created and export the Nike data, the most current Nike data, and put it into this spreadsheet so we can continue on with our valuation. It's also a step that you're going to be doing in the future. So I'm going to show you how to update the model as you either update it with more current data, which is what we're about to do for Nike, and or if you had to use the model for a different company. So in Bloomberg, you should have created, so if you go to Nike, and we're using the Class B shares, so Nike US equity, then you'll go to FA, and under FA, you'll go to Custom, and you'll go to your model tab that you had saved or whatever you called it for the last assignment. And since you're on Nike, then all you have to do is go to Export Excel Current Template, and you will have Nike's most recent information through May 2019. And just as you did for your homework assignment, we have to get rid of the long dashes with zeros. So find all of the long dashes, replace with zeros, and replace the 32 long dashes with zeros. So I'll give you a second to catch up. But basically, everyone will need to do that. So as I said, if you've done your homework, this is a process that takes you, 2 minutes. Yes?
I have a question for the fundamentals of the settings. Do you want it standardized or actual?
For which one?
Just for the exported.
Use the standardized one. Leave the default one that's there.
Okay.
Yes?
How many replacements are there for this one?
32. 32 long dashes. Don't replace minuses. That'll be bad. Okay? Now, so what we've just done is we've taken, for whatever company, this happens to be Nike, we've exported the most current data that we can then update our model with. Right? So once you have done this, the next step would be to select this whole tab. So in the upper left-hand corner, select the whole tab, click on it. Then go to the other spreadsheet, the valuation model that we're going to continue working on. Go to the Model Data tab, select that whole sheet, right-click, Paste Special, Values. Okay, so that's what we want to do. So take the Nike data, select it, copy it, go here to the model, right-click, Paste Special, Values. All right, and that will overwrite cell for cell all of the data with just the numbers. Don't paste copy paste. If you copy and paste tabs across sheets, what will happen is Excel will make a reference to link to that other spreadsheet. So every time you open this valuation model, it'll say, where's the other file you just copied and pasted from? So you don't want to create a link across models. So therefore, copy, paste special values. You're just moving the data between the worksheets. Don't just copy, paste. Okay? The next step to check to make sure you didn't make a mistake is in our valuation model, then go to the CFI tab, look at the balance check, and make sure that the CFI is still in balance. All right? And that's also a very important practice, because if the CFI doesn't balance, then there was a problem with the data that you copy and pasted in. Either you copy and pasted it wrong, so that can alert you to do it, or in the off chance Bloomberg added some other field that we would have to track down. Okay? But again, this is just one way to help check that when you put the data in, it went in correctly. So if you get a CFI that balanced, most likely in good shape. All right, so that's the first step for what we need to do today. All right, so now we have the data in our model that goes from 2014 through 2019. Yes?
Paste, you just copy, like, I missed it, but sorry.
So once you come to this model, you go to the previous model, select the tab, and then in this model, once you copy it, select this model data tab, right click on your mouse, paste special values, or edit paste special values. But you don't just paste. So don't just control V. Okay, you want to paste the numbers, just the numbers. That's called values. All right, the other change that we need to make is under the assumptions tab. Last reported year is now 2019. So we're going to switch cell B2 on the assumptions tab to 2019 so that the rest of our model has the correct relative referenced years, since we now have 2019 historical data in our model and 2019 is no longer a forecast. Okay? So again, you don't always have to change the last reported year, because, for example, if we were using Nike and then we did Under Armour and they were still in the same year, we may not have to change the last reported year. But the idea here is this is how you update your model. And your next homework assignment will involve this next week. Okay? So you're going to have to take the PVH data once we finish this model and put it into Nike to value PVH, just as what's coming up. Okay? But this is how you update the model.
So it's the same copy paste no matter what company.
No matter what company. As long as it's a publicly traded company tied to Bloomberg, it will work. Okay? All right. Other questions? Great. That was the whole point of the template. That's why we did the raw data template, because we don't care who the company is. We can just export their data. Yes?
What did you say was the check again to make sure you
Go to CFI. Make sure that your CFI still balances. Look at that balance check line at the bottom of CFI. It should still balance. Because generally, if there's mistakes with data, you'll have a non-balancing CFI. And then you'll have to troubleshoot. Okay? But that's also one, just make sure I typed it in correctly. I didn't accidentally get rid of like the long dash. I typed in a short dash, and I got rid of all my negative numbers. So things like that, it'll cause your CFI to not balance. So just make sure, as I said, you're going to notice that we do a lot of double checking in this class. All right, back to this. Our next step is to create a valuation of Nike based on this data. So we're going to go to the end of our series of tabs in our model, and we're going to add a brand new worksheet at the very end, be the last tab in our model, and we're going to call it the valuation sheet. Put mine here at the end. Just click on it, rename it, valuation. All right, so now we're going to follow Modigliani-Miller. So operating cash flow, which is free cash flow, plus non-operating cash flow should equal enterprise value. So let's start out with our operating cash flow. The operating cash flow in cell B1 is going to be called the free cash flow. And the first year of free cash flow is going to come from the CFI. So for column A2 equals Go to our CFI tab. The first forecast year is H2 off of CFI. And we are going to use the first 5 years, but we'll start out the 2020 free cash flow. Cell B2 equals from the CFI 2020 first forward year free cash flow, row 13, so H13. And I'm going to just get rid of a couple of decimal places by using number format, just makes it cleaner to see. And so for the model, we need the first 5 years, so relative year plus 1 for the years. And I'll copy that down 3 more times. We need the first 5 years of forecasted free cash flow for Nike. And that's all going to come from the CFI tab. So again, if our ratios came true, these would be the free cash flows that Nike would have for years 2020 through 2024. So for second forward year, 2021 equals CFI. I is 2021. 13 is free cash flow. I 13. 2022 CFI. J 13. 2023 forecasted free cash flow is K 13 off of CFI. And 2024 free cash flow equals off of CFI L 13. And again, back to 2 decimal places. All right, so those are the first 5 years of forecasted operating free cash flows. So it's going to be very important that I present value those. So I got to put these into present value. All right, so a simple way is present value is cash flow divided by 1 plus R to the N or T. So I have my cash flow times 1 over 1 plus R to the N or T equals present value. That's the discount factor method. If you want to be advanced and use Excel to do it, feel free. But the point is, we need to get a present value of these free cash flows. So I'll do the discount factor method to get the present value of the free cash flow. So equals 1 divided by left paren 1 plus R. What is my R? It's my WACC. So the discount rate we're going to use to discount the cash flows is the WACC. So that is on the assumptions tab. B4. Right paren. So that present value of the free cash flow equals the free cash flow times the discount factors, 3097.28. Okay. Now, I'm about to copy the discount factor formula down, so I have to make sure it's an absolute reference to B4. So $sign in front of the B, $sign in front of the 4. Okay. And then copy, paste this down. Copy B times C, paste this down. But finally, for the second year, this is 1 divided by 1 plus R. For the second year, 1 divided by 1 plus R squared. So at the end, shift 6, called the caret 2, is squared. C4 at the end, shift 6, 3 for the third power. The end, shift 6, fourth power. And then shift 6, the caret, fifth power. So that the present value of the operating cash flow first 5 years is the sum of those 5 present values. So again, assuming our forecast comes true, Nike is going to generate about $15,392.78 million of free cash flow, present value, selling its products in the next 5 years. Right? But the key is that Nike doesn't end in 5 years. Hopefully not. Hopefully it keeps going. So the assumption that we make for companies is that companies last forever. Now, we don't know if they truly will last forever, but we do value companies long term. That's called continuing value. Right? So year 6 is the beginning of the continuing value period. Right? That was arbitrary. Right? We did 5 defined years. Year 6 was the continuing value. We could have done it a different way, but we chose arbitrarily 6 years in this class. So that's why I mentioned that we forecasted 6 years. 5 years, year by year, year 6, continuing value. We could have done 10 years, year by year 11, continuing value. Okay, that was the choice that we made. So again, I need to then forecast, row 9, the continuing value for Nike, or the perpetuity value, in interchangeable terms. Okay. So here's what we're going to do. That is a perpetuity, and we're going to use the key value driver equation for the perpetuity. Okay, so that is the growing perpetuity that we're going to use to value the long term. Okay, so no plat times 1 minus G over ROIC divided by WACC minus G. Okay, so in this cell, B9, we need that formula with those 4 data points. Except I might change those continuing value assumptions as we go through and make some assumptions about Nike or any other company. So I'm going to actually put the components of those formula on the assumptions tab. And one of the components is already there. It's called the WACC, and I have to add the other 3. So I'm going to need a continuing value no plat. I'm going to need a continuing value ROIC, and I'm going to need a continuing value G, long-term growth rate. And all 3 of those are going to be yellow cells because those are things I could eventually change, but I need to put the placeholders in as we're building the model. So let's talk about the continuing value no plat. We're going to use the year n+1 or t+1, the 6th year, as the beginning of the continuing value period. That's why we always add 1 year to our model. So in our case, the continuing value no plat equals, from the TII screen, the final year, column M is the 6th year, M5 is no plat, so M5 off of TII is our starting no plat. 5809.35, rounding off. Okay. The beginning of the continuing value ROIC, we're going to use the end of year ROIC as opposed to the beginning of year for this one. Just a choice I'm making. We can always choose a different one later, but it's a choice I'm making now. Equals, off of the economic profit end of year tab, EOY tab, the continuing value period starts in column M, 2025. The ROIC after goodwill is row 16, so M16 from EPEOY. And that is our beginning percentage continuing value ROIC, approximately 38.4%. The final continuing value assumption we will need is the G. What is the long-term growth rate in perpetuity? As a placeholder, we're going to use 3%. The idea here is we need to know what the company is going to grow in perpetuity. One of the simplifying assumptions we're starting with is for basically US and European-based mature companies. You're probably going to grow with your country's GDP long-term, so therefore 2 to 3%. So I'm just going to use 3 as a placeholder. We can always adjust this later. So for example, if I were using China, I probably wouldn't use 3% right now, use a higher number. But nonetheless, we could basically adjust this at a later date, putting 3% as the placeholder right now for Nike. Okay. So now that we have the 4 components of this formula, we're going to put this formula in this cell. So equals left paren, we're going to build it off of the assumptions tab. So the first one is our continuing value no plat, so B5, times left paren 1 minus the CVG, which is B7, divided by the CV ROIC, which is B6, right paren, divided by left paren, the WACC, which is B4, minus the G, which is B7, right paren, enter. If I did it correctly, 111,569.33. All right. So the only tricky part here is just getting the right order of operations. So again, assumptions B5 times left paren, 1 minus assumptions B7 divided by assumptions B6, right paren, divided by left paren, assumptions B4 minus assumptions B7, right paren. Sometimes you might have to do it a couple times, but nonetheless, that's the value of Nike, cash flow, operating, year 6 into perpetuity, long-term value. But here's the deal. I need it today. I got to present value that. So the perpetuity actually discounts it to the beginning of year 6. I need to bring it to today. Now, I don't double discount year 6. It's already been discounted by the perpetuity formula. So to bring it today, I use the same discount factor as year 5. Equals that times that, 76,639.21, which gets me a total operating value for Nike. Add the 15,392 plus the 76,639, 92,031.99. So again, assuming our ratio assumptions come true, Nike will generate about $92 billion of free cash flow present value in the future. Operating value plus non-operating value equals enterprise value. So we're just following Modigliani-Miller. Okay? So the next piece is to this operating value, we have to add the non-operating value. Here is where the TFI will help us. For cell A13 equals, off the TFI, we have the non-operating assets. They start with excess cash, non-operating assets, long-term investments. These are the 3 non-operating items from our TFI. Excess cash, non-operating assets, net non-operating liabilities, long-term investments, and receivables. Now the beauty is we're going to start with the last reported amount, which is already in a present value. Okay, that's today's value of each. So excess cash equals, from the TFI, G is our last reported year, excess cash 10, so G10, G11, G12. Those are the 3 non-operating items that we're going to add up. So this will be my non-operating value, is the sum of those 3. One of the other assumptions that we make in valuation is I don't buy Nike because they own land in Vietnam. I buy Nike because they make apparel and shoes. All right. So future non-operating assets, we're going to assume would be NPV 0. They're not good at non-operating things. That's why they're non-operating. So anything new non-operating we'll assume is NPV 0, and anything currently non-operating will value it at the business today. If you ever wanted to change that assumption, you always can, but generally that's what's pervasive out there. Okay? So with that in mind, if we add these 2 together, the operating and the non-operating value, we get the enterprise value, which equals the operating plus the non-operating value, which is 94,576.65. It is this enterprise value, which we know equals the value that's going to be distributed to the debt and the equity holders, the interest-bearing debt and equities, the 3s and the 4s. So here's the deal. If we pay off all of the interest-bearing debt and all of the non-common shareholders, then what's left is what goes to the common shareholders. Again, this is where TFI helps us. For cell A21, who do we have to pay off? Equals, from TFI, well, we have to pay off the retirement-related liabilities, which is A15. We have to pay off from our TFI A16, which is the interest-bearing debt. We're going to have to pay off, we're solving for common equity, so we don't do that. But we then have to pay out the preferred shareholders, which is A18. And we have to pay out the minority shareholders, which is A19. Those are the 4 other non-common stakeholders that would be paid before the common shareholders would get the money, or the residual. Okay? And again, the amount that we owe them is the current amount in the balance sheet. So that would be for retirement-related liabilities, off of the TFI, column G, its last reported number. That would be G15. Interest-bearing debt off of TFI would be G16. Preferred shareholders, we owe them G18. And G19 should be the minority shareholder current amount outstanding. So if we pay all of this off, we'll be left with a common equity value equals the enterprise value minus the sum of those four things, 91,097.65 million. So again, if our ratios come true, Nike's worth to the shareholders a little over $91 billion based on these assumptions at that discount rate. To get to a share price, I divide by my shares outstanding, common shares outstanding. Now, I don't want to put the number of shares outstanding directly into the screen because this is going to change company by company. Because if I reuse this, the share count will change. So on the Assumptions tab, and I'm going to skip a row, start with row 9, A9, shares outstanding. And I'm going to make that yellow. And so I need to get the current share count. So this is where we now start getting some additional data from Bloomberg. So there are going to be 3 screens in Bloomberg that you're going to use pretty regularly to help you get data for these valuations. The first one for the company is called DES, the description. 2 things are going to be on the screen. One is the shares outstanding. It's right here. Current shares outstanding is always here in Bloomberg. Right here, bottom left. 1,246,000,000 shares, 1246. Okay, so I'm going to go ahead and put that into my model, 1246. And then come over here to valuation. I'm going to reference that, equals, back to my assumptions, the 1246. So that my share price equals that divided by shares, equity valued by shares. In fact, I'll call this my model share price just so you don't get confused. 73.11. Which, by the way, if I go back to my DES screen, across the top, they're at 94 and change today. So we're not that far off from the current share price. But the point is, we got to get to within $1 as we continue on the model. But this is the first part. We've now pretty much completed the core of how the model works. And now we're going to get into refinements, but we're 80% done. Okay, and this is real world. So this will work in the real world. You'll see in just a minute. So let's continue on. The other thing we're going to use for this is at the top of the DES screen is the current share price. So today, for all the classes today, we're all going to turn in a model for homework 7 that exactly matches the Nike share price that I have, which is going to be based on the 11 a.m. section today. Okay? But when you're doing your assignments the rest of the semester, you're going to be doing the assignments at different times of day. Somebody might do it on a Thursday, somebody might do it on a Friday. Share price is bouncing around. It's bouncing around right now. So the share prices won't be the same for the companies that you're even doing similar assignments on, even if everybody's doing the same assignment. So one of the things you're going to do is you're going to turn in the DES screen with future assignments, because when the TAs grade this, or if I'm grading it, I'm going to look at the share price at the time that you submitted your file, and everything needs to be in sync. So as a matter of fact, there's going to be 3 screenshots you'll take. You need to take these screenshots within seconds of each other, okay? Because you really want these to be in sync for the model that you have. Because you don't want to do the share price today and, for example, the cost of capital tomorrow, because if something weird happens with interest rates, which in normal times I wouldn't be worried about, but we're not in normal times anymore. So given that something could really happen over the course of 24 hours with interest rates, we want to have whatever is in sync with the current share price. So back to this, we're going to take a screenshot. How do you take a screenshot? Here, take screenshot, save. Now what I'm going to name these files is the first one. It'll be the way you'll just see it for me, is I'll put the ticker symbol, NKE, hyphen, and then the Bloomberg name that I got it from, in this case, DES. All right, so I'm going to post these a little bit later just so that you guys have a roadmap or a recipe on what screens to get in Bloomberg. All right, and the other two you can see up there, WAC and EEO. In fact, let's go ahead and do the second one. I also need a current WAC, WACC. Might as well go ahead and do that now. So this would be Nike's current WAC, 7.7. Again, I would take a screenshot of this and save it. And then I come back to my model. And in the assumptions, I change the 7.8 to 7.7. Notice when I did that, the share price changed to 74.75. This is the nature of the dynamic model. Everybody with me on that? Straightforward? Okay. Now, next step. As I said, we're trying to get to an as-is valuation. So we want this model share price to be within $1 of the 94 and change that Nike is trading at. The dollar is the standard that I'm looking at. And so again, an as-is valuation is something people usually skip over in the real world. Usually when they do share prices for companies, they go straight to the target. Here's what I think you're worth. But this semester, I'm going to force you to do what's called an as-is, which is before you tell me what you think the company's worth, value it today at its current share price. Because the whole idea is cash flows lead to price. So if you know the price, we can use our model to back out to say, here's what the cash flows have to be to justify the price. Now, we may or may not agree with that, but then we could change that when we create our own version of what we think the share price should be. All right? But I find it to be very instructive to understand what the real world is using to value Nike at. Because whatever we agree or disagree with, people are paying this price for it today. And cash flows have to equal that. So let's figure out, using this model, what those cash flows have to be. Okay? So again, it's not that I agree with it, it's just math. So that's what I mean by an as-is valuation. And that's what we're going to complete right now. So how do we do that? Well, most of it, we already started, we need a same WAC, is going to be based on the ratios. And a lot of it's the operating value, which is free cash flow. And highlighted in light gray on the screen are the three most important factors for free cash flow: growth rate, EBITDA margin, and tax rate. Because gross cash flow is NOPLAT plus depreciation, and a proxy for driving the NOPLAT is your revenue growth rate and your EBITDA margin. Okay? And then the tax rate you pay. That's your gross cash flow. Okay? That's your NOPLAT. So essentially, that's most of the valuation. And we got to get these numbers right. So here's the question. We need the next 5 years to have more realistic sales growth rates, and we need to have more realistic EBITDA margins for Nike. And I need to be based on the actual price of Nike. So where in Bloomberg might we look to help get this information? Because again, this is real world. I want to value Nike. What in Bloomberg is going to help me figure out the forecasted share price and the forecasted cash flows? Where would I look? What screen? He knows the answer. He's already on the screen. It's EEO. EEO is going to be one of the most heavily used screens you're going to use all semester. Because here's the point. A&R are the analysts. These are the sell-side analysts that are doing the exact same thing that we are. They are creating a valuation model to create their buy-sell hold opinions that's cash flow driven. And they are taking their valuation estimates and their cash flow estimates, just like we're forecasting, and they're uploading them to Bloomberg to create something called the consensus estimate. So I want to be very specific about how the consensus estimates, which is the forecast, wisdom of the crowd for a company, public company. First column, actual, then forecast, estimate, 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 forward year 1, 2, 3, 4. Okay? Revenue, EBITDA. Let's focus on the 2020 revenue forecast that the analysts do. Now, I want you to look at this number here. 27, 27, 14, 3. So here's how it works. There are 30 analysts that are uploading a revenue forecast for Nike out of a spreadsheet. Bloomberg found 3 of those 30 numbers to be mathematical outliers. The remaining 27 fell within a range of 41,959 to 42,504. They averaged those 27 left, and they got 42,194. That's exactly how the consensus estimate is created. So the analysts upload their guesses. The guesses are averaged. The average of the guesses become the consensus estimate, wisdom of the crowd. Okay? So here's the thing. 27 guesses in the 2020, 27 guesses, 14 guesses, 3 guesses. Now, here's the thing. Every analyst has a model just like ours, and they had the forecast 2023. Yet 3 of them are actually publicly being stated. So here's what happens. As an analyst, Bloomberg is tracking every guess that you upload. And if you're wrong, people will know. So the analysts have the guesses. They just don't like to put themselves publicly out there too far in the future because they don't like looking wrong. Because when you look wrong, people don't want to pay you money to subscribe to your research. So what you'll tend to see is that everybody's got a 5-year forecast, but once you get past year 2, the amount of analysts that are willing to publicly show that starts to go down, right? So for purposes of this class, we're going to use the first 2 to 3 years pretty consistently because those are the most heavily forecasted, and they're pretty packed together because those usually are easier to forecast and not be too far off. You'll have to use your judgment about whether you want to use years 4 and 5 for the companies that you're valuing, because if there's like one person out there guessing year 5 and there's 30 analysts, I'm not saying that that one person's giving me the most comfort that they're the most right? But it's a data point. And nonetheless, we have to come up with a 5-year forecast, but at least the first 2 to 3 we're going to use. So we're going to build this model for Nike, assuming we're going to use the first 3 years of consensus estimates. So back to the assumptions tab. We're going to take a screenshot of this screen, which I've already done earlier today. So let's go back to our assumptions tab. So here's what I want you to do. I'm going to shrink the screen so it's a little bit easier to see. So the first 3 years of forecast relative equals last reported year plus 1, and then equals plus 1, and then equals plus 1. Those are the next 3, forward year 1, 2, and 3. I need the consensus estimate for revenue. And I need the consensus estimate for EBITDA. So I can also get the consensus estimate for EBITDA margin. Okay? So I'm going to make these first 2 cells C11 through C12 yellow, and C13 we're going to solve for. So let's go ahead and do so. So using the numbers from the analysts. So earlier today, I had downloaded the numbers. I don't think they have changed, but let's quickly look at them. So here is the EEO. And I want to basically take 2020 revenue, which is 42,194, and I want to put this in here, 42,194 billion. 2021. So I'll go by the screenshot just so I'm matching. I don't think it's changed in the last hour, but where'd it go? Sorry, trying to saw the screenshot. EEO. Then 45641. 45641. And 2022 is 49273. And then for EBITDA in dollars for 2020, the consensus is 6282. For 2021, the EBITDA consensus is 7175. And finally, 8158. So if I were to take the EBITDA, so C12, and divide by revenue, C11, the margin, 14 point, round off, percent, 14.9, copy, growing over the next 2 years to 16.6. So one thing I can already see in the consensus estimates is that the analysts are expecting Nike's EBITDA margin to improve over the next several years. All right, so I'm going to put that into my ratios model. So going over here to the ratios, I want these numbers to now be the consensus estimate, which means I'm going to take the yellow color away because I'm not going to change those anymore. So I'm going to clear that out. I'm going to unyellow these. And I'm going to replace the 2020 EBITDA ratio with, from my assumption, the 2020 consensus estimate margin for 2020. For 2021, I'm going to take the assumption for 2021, which is D13, and for 2022 equals assumptions E13. By the way, when I do that, my share price, 91.62, starting to get really close to the $94 actual share price, which again shouldn't really be a surprise because we're using the assumptions that Wall Street is in a real world DCF model to create a valuation of a real world company, and they should match. So let's go back. Everybody see what I just did? Questions about that? All right, next step. Got to do the same thing with the revenue growth rates. So I want these three revenue growth rates to actually solve to get me the real world actual growth rates that the analysts are projecting to get those numbers. So I don't want to use my own assumptions. I want to use the analyst assumptions for growth rates. So I'm going to unyellow those two for the 3 years. So the formula for percentage change is current year minus previous year divided by previous year. That's the formula. So here's what we're going to do for 2020. Equals, left paren. The current year is from the assumptions, C11, minus the previous year from the income tab, G3. Right paren divided by previous year from the income tab, G3, so 7.9%. Okay, I'm going to do this again for 2021. Equals left paren, current year from the assumptions tab, D11, minus previous year, C11, right paren divided by C11, 8.2%. And for the third year, equals left paren, assumptions, E11 minus D11, right paren divided by D11, 8%. Those are the numbers that the analysts are actually using today. And by the way, with those growth rates, my share price is $93.88. Now, here's the thing. I'm getting tired of going back and forth. So the other thing I want to do is two things. First, on the Assumptions tab, I want to put right here under the shares outstanding, I want to put an assumption for the current share price. What is the one in yellow that we are solving for? Now, for this one exercise, I'm not going to actually use the current share price right now. I'm going to actually use the share price from the 11 a.m. section just so we're all matching. And so in the 11 a.m. section today, the share price was 94.56. So 94.56 is the one that we are matching on. 94.56. Where's video here? So 94.56. Because again, it's going to change around, bounce around throughout the day. But just so we're all using a similar share price. Okay? Everybody with me on this? All right, so let me continue. So here's the point. What I'm going to do is on my Ratios tab, I'm going to come down here, and I'm going to put into cell G26, I'm going to put the current share price, and the model share price. So that way, every time I change something, it's right on the screen for me to see, and I don't have to keep jumping back and forth across the tabs. So my current share price equals, from assumptions, B10, and my model share price equals, from valuation, D30. Those are the numbers I'm actually trying to sync as well. So I just want to put them both on the same screen. Now, technically, I'm within $1, but I'm not quite done with the assumptions. I got two more big assumptions I got to cover. The next one down, I talked about three key assumptions: growth rate, EBITDA. The next one's tax rate. Right now, we have 21% as a placeholder, and our goal is to find a realistic tax rate for Nike going forward. So again, I'll go back to Wall Street. The Wall Street analysts that work for JP Morgan and Morgan Stanley and Goldman Sachs, they're all trying to do the exact same thing. Okay? As a matter of fact, on the earnings calls that companies have, you know what the real reason for the earnings call is? Nobody cares. Really, nobody cares about the first 10 or so minutes with the scripted press release. I can read the damn press release. Get on with the Q&A. What's the important point of the Q&A in the quarterly earnings call? What's the whole reason why they do the Q&A? What are the analysts asking questions for? What's the goal? Anybody know? What do you think analysts are trying to get out of their questions on that earnings call? I'm sorry? For what? For their spreadsheets. They have spreadsheets just like we do. They need to figure out with new data how to change their assumptions. So the whole point of those questions are to get, as you said, the better estimates so I can figure out what assumptions I change in my spreadsheet to understand the impact on your valuation. That's why you'll see several analysts ask the same question several times, because they all are trying to get to the same number and they don't like what they're hearing, so they're trying to figure out the game to get the company to help them guide them. Okay? And the company can't give them a specific number, and sometimes the company doesn't want to give them numbers at all, but everyone still needs a tax rate. So two places we're going to look for the tax rate. If we go to a screen in Bloomberg called EVT, this is the event calendar, and it has all the calls and all the presentations that the company's doing. All right, the last earnings call was right here on September 24th, and this is the next one on December 20th. And you'll see that in Bloomberg, they actually give the PIN, the dial-in number and the PIN to get unmuted. If you're truly brave, right before the call starts, go to Bloomberg that you want to listen to, see if you can dial in with the PIN and see if you get unmuted. Maybe you'll be able to ask some questions. So they figure out you're a student and they hang up on you. But in any event, this is where the analysts get their PINs, okay, to be unmuted. But here's the other nice thing about Bloomberg, which is here. They have a recording of the call, right, and the transcript, which is an actual transcript, not a summarize edit transcript, but they're literally transcribing the call automatically as it's being held at the end of the call. a transcript within a minute is up here on Bloomberg. So you can get a transcript of every earnings call, which is pretty nice. So here's a nice thing about the transcript of the call. I know that there is going to be a question about the tax rate on every call. It's going to come up. I need to know your tax rate. So what's your tax rate? So let's do a search for tax rate. And there were 3 mentions of tax rates in the last earnings call. Now I can go read the whole thing, but basically it says last quarter was 2.4, effective tax rate going up mid-teens, effective tax rate mid-teens. So whoever's answering these questions, we can go to the part of the call to look at it. But the point is, they're guiding the analyst to mid-teens. So we could actually use that in our model. But here's the other place you can search for it. BRC. This is the research portal, Bloomberg Research. Now, our education subscription for Bloomberg doesn't give us access to all the analyst reports. We only get some of the analyst reports, right? But we do get JP Morgan's, sometimes Deutsche Bank, sometimes you can see here Needham. There's a few others, Stifel, but we don't get all of them, right? But here's what I'm going to do, and you can actually see this here. JP Morgan, right after the earnings call, had one called Model Update. Okay, kind of a key word there. So I'm going to open up this JP Morgan Model Update, which is their research report they sent to their clients. And basically, this is all of their key assumptions in their valuation model that they're giving out to their clients. And if you scroll down, you can see that JP Morgan's model for revenue, EBITDA, growth rates, EBITDA margin, ROIC, free cash flow, they're here for the next 3 years. But more importantly, tax rate. Adjusted tax rate. 16.1, 15, 15. So I'm giving you several sources to find this data. Okay? And again, this is a little art because we don't always agree on unanimity. But the company guided to mid-teens. JP Morgan's coming out around 16, right, ish, 15 to 16-ish. We could look at a couple of analyst reports. But I actually think 21's too high. So Nike, the number we're going to use is 16%. And I'm going to copy that equals 16 and copy that forward. Now that's going to change your share price to 100 because obviously you pay less taxes, you're worth more. So the final part of the ratios, we've now finished the gross cash flow. We now have to do the gross investment to the free cash flow, which means we have to look at the balance sheet and the balance sheet ratios. I want you to change the formatting of H24 through M24 from percentages to just decimal place. And I'm going to unhide these historical years. But when we created these balance sheet ratios in the last class, I said that every one of these balance sheet ratios was a percentage of sales. And I said we were doing it for 2 reasons. The first one I said it was easier, and I said there was a second reason which would become apparent later. Well, here we are at later, right? Every one of these ratios is a percentage of sales. Guess what happens in the balance sheet when we have a revenue growth rate that goes up? And the balance sheet's a percentage of sales. What also happens? The balance sheet goes up. And if we take the 2 balance sheets and we subtract, we get gross investment. So by making the balance sheet ratios a percentage of sales and tying it to sales, every time we forecast sales, we're forecasting a balance sheet. And by forecasting the new balance sheet, we're forecasting gross investment. Now, implicit in the assumption of tying everything to sales and not changing it is that the company's productivity, its invested capital to drive sales ratio, is not really changing. Look historically at Nike's IC to sales ratio. It's been pretty consistent, 0.25 to 0.27 to 0.29. It's a little bouncy, but not too much over the last 6 years. So I don't think Nike's productivity is going to change that dramatically. So the approximate level of investment to sales is going to stay the same. So therefore, I don't need to muck with any of those balance sheet ratios. For 80 to 90% of the companies that you value this semester, you probably don't have to change the balance sheet ratios. Because unless the company is going to be I'm going to sell off all my assets and lease them back, or I got giant inventory for the last few years, and now I'm going to cutting inventory, or I screwed something up, productivity is probably not going to change too much. So therefore, the convenience of tying the balance sheet to sales is most of the time we don't have to worry about forecasting the balance sheet. So given this, this is not something that I need to change. I'm comfortable with the forecast, right? So here's the last thing we're going to do to complete our model today. Go back to the assumptions tab. We're going to look at, and this goes into multiples. And you haven't gotten to the book yet, reading on multiples, so you're going to get there soon. And we're going to spend a lot of time on this in a few weeks. So for now, I'm just going to say, trust me that this works, okay? But basically, we're going to look for two multiples. The first one is the enterprise value enterprise value to revenue or sales ratio. And then we're going to look at the enterprise value to EBIT ratio. And these are going to be the forward. So forward EV to revenue and forward EV to EBIT. And the year that we're going to care about is the second forward year, which is 2021. And the reason why we're caring about the second forward year, as the book will eventually explain, is that is what becomes more normalized, okay? Because when we do multiples, we actually use a perpetuity. And the multiples are actually a derivation of the key value driver formula. So if you actually take these two multiples and you divide the enterprise value to revenue or sales, and you divide it by enterprise value to EBIT, you get the estimated EBIT margin for a company. You actually get EBIT divided by sales. That's what's left if you divide the two ratios and cancel out all the math. So hiding in plain sight, the enterprise value to revenue ratio, you will find on the EEO screen. And that's why it's important to do these screenshots similar, because you need to have the multiple, which is changing in real time, sync up with the share price. Okay? But right now, second forward year, 2021, EV to revenue, 3.32. EV to EBIT, 24.08. Equals the first, EV to sales divided by EV to EBIT, 13.8%. So, hiding in plain sight is the perpetuity EBIT operating margin that the Wall Street is using for Nike. That number is this number for 2025. So instead of 14.8, Wall Street believes that number is going to be 13.8. Has to be based on the trading multiples. That's what the math says. So we know what the continuing value EBIT margin needs to be, 13.8. But that cell says 14.8, so we need to drop it by 1%. But that's not a yellow cell, and if I change it, it's going to break my model. So I can't change that cell. So the question is, how do I get that to 13.8? I either have to change one of the two cells above, I either change depreciation, or I change EBITDA margin. Now the depreciations for Nike haven't really changed that much over time, so that's probably not going to swing a percent. So what I'm going to do is I'm going to take my EBITDA margin from 16.6 to 15.6 to get that to be 13.8. Okay? So when I actually use the trading multiples to get the EBIT margin into perpetuity, I am 4 cents within the share price this morning. This isn't magic. I told you at the beginning of the semester you're going to build real world models. This is real world. Hard part of the real world are the assumptions. Easier part for the as-is model is you don't have to make them. See, what you're doing is you're recreating the assumptions that Wall Street has made for Nike. That's why I know this works. Because it has to. No other way this math is going to work. It has to work. The math equals the cash flow equals the price of the company. So we know the price, we know the math, and we have a sense of the cash flows. We're just solving. All right? The art of the valuation is saying, do I believe these assumptions? We'll get to that next class, because that's what we're going to get into the next 3 models, which is the bull, bear, and our eventual target share price. Because I may disagree. I may disagree with Nike's growth rate. I may disagree with this margin. And I could change share price accordingly. But if nothing else, by doing the as is, I know what the wisdom of the crowd is. I know why Nike's trading about 94, 95 a share, because the market believes that Nike's going to grow about 8% a year. Their EBITDA margin is going to grow a little, and then it's going to start to shrink over the next several years. And that the productivity of the business isn't going to change that much at this level of cost of capital. I know that because that's what we just confirmed by doing the as-is valuation. By the way, this is homework 7. If you get to this point with this price, with this model, you're done. Upload, save, put it in your homework 7. That's it. Individual. Can't use somebody else's, got to do it yourself. But this is the valuation model for the class. Now we're 95% done. We now have a reusable model. So I'll tell you where we're going from here in the next class. So like I said, get to this point. I'm allowing a range for grading, because the way you're going to be graded is to have everything done and have a share price that matches mine of 94.52. But I'm going to tell the TAs I put in the assignment plus or minus 10 cents. There's no reason to be more than 0 off. But if for some strange reason you have like some decimal point problem, I'll give you a 10-cent range. But you got to be within 94.52 plus or minus 10 cents to get credit for this homework assignment. Yes?
This specific homework, do you need screenshots?
No. For this specific homework, good question, you don't need screenshots. And the reason why you don't need screenshots is because I'm basically syncing everything to the 11 a.m. class today. Right? And so therefore, your screenshots by definition would be different and would cause some variance in the numbers. And for purposes of making sure that we all have a common model, I want us all to have a common model today, right? Because here's what's about to happen. So on Monday, after we finish, your next homework assignment is going to be homework 8 after this one, which is PVH. You're going to basically take the PVH data and repeat this process yourself as an individual assignment to do PVH, and you're going to give me 4 Excel files, an as is, a bull, a bear, and a target, and a write-up with a buy, sell, hold opinion explaining your assumptions along the way. That'll be what we cover on Monday, finishing up for Nike, and you're going to repeat that next week for PVH. And by the end of that, the following week, when we get that homework is due, week from Monday, PVH one, that model will be the model you'll use for your group projects. So you'll then, I'll pick an industry by class, you'll pick a company, and then for the final month of the semester, you're going to spend a lot of time working on 20% of your grade, which is working on that company and assessing it. And by the end of this week coming up, we'll have completed 3 parts of the 4 parts of this class. EIC, which is the first part, which you'll be able to do on the company that's assigned that you pick. Second is the historical, CFI, ROIC tree analysis. And the third part is the valuation. The only part that we wouldn't have done is the multiples, which we'll work on starting in a couple weeks. But content-wise, we're done with 3/4 at the end of next week of what you need to do to build the model and work on your projects. And again, practice, practice, practice. So what really separates this half of the semester from the first half, every class going forward, you'll be working on a real company, right? And I don't know what they are. I really don't, because I'm going to start making up assignments from the headlines. So I'll, a couple days before class, even sometimes that morning, I'll look in the Wall Street Journal. I'll see what's going on. The interesting companies are the ones that I will choose. It won't be an industry that you'll be assigned as your class. So for example, last semester we did airlines. Last semester they did tech companies. Last semester they did healthcare companies. So I'm going to choose different industries. So you don't repeat what we did last semesters. But regardless, you're going to basically be doing that coming up. So that's kind of where we are, where we're going. All right, questions about this? All right, so again, today, there's no write-up for today's assignment. So if you got to this point, you finished this model, you match the share price, upload, done, enjoy the next few days off, come prepared, ready to start working on the next 3 parts of this model, which is the bull, the bear, and the target, the buy, sell, hold opinion. That's what we'll cover on Monday's class, right? And then we'll set up your next week's homework assignment. Back to the stock sim, you don't have to do anything at the end of the day. I'll take some screenshots at the end of the day, and I'll post, and you'll see how you did against your peers. But again, we're continuing on with your portfolio. So you don't have to liquidate. You just keep trading, and we'll do another check-in at the end of the semester. All right, no other questions? Great, see everybody on Monday.